Thank you.
And countless times on the show, we've told you about the benefits of exchange-traded funds. You buy exchange-traded funds, there's all kinds of varieties. They're cheap, but they beat out their pricier actively managed counterparts sometimes. But not all are created equal. Tonight, a look at the worst categories of ETFs with Kiplinger's personal finance reporter, Kaitlin Pitsker. Kaitlin, thanks for coming on the show. So, we've been touting the benefits of ETFs forever. They're cheaper. As a result, your performance is better. But you say not all of them are great.
Well, thanks for having me. I'm happy to be here. As you said, there's a lot of benefits to ETFs, but unfortunately, there are a number of types of ETFs that aren't necessarily great for most investors.
All right. Well, I want to get to your list because I think it's terrific. And let's start with leveraged ETFs. What are they and why are they dangerous?
So leveraged ETFs aim to return double or triple the underlying benchmark. And if you feel sure of the direction of an index, this might sound like a great idea, but you're exposing yourself to a greater amount of risk that you really don't need to be taking on.
Okay. They can beat you down. Inverse ETFs. What is that and why is it dangerous?
Absolutely. So inverse ETFs seek to return the opposite of the underlying benchmark. And a lot like leveraged ETFs, the results over a longer period of time can lead to some ugly math. Both of these types of ETFs can only return the promised index return on a daily basis, and over longer periods of time, you end up with a difference in returns.
So, Kaitlin, how are they doing this? What does a leveraged ETF use to get its results?
Well, as I said earlier, a leveraged ETF is tracking double or triple the return of the underlying benchmark. So you're really just amping up your risk factor there.
And you don't like obscure country ETFs. Tell us about that.
No, we're all for exposing yourselves to emerging markets, and if you want to add, say, a dollop of powerful German companies, or even if you want to invest in India, that's one thing. But if you want to go out into some of these really obscure emerging markets, you really need to know what you're working with. There are some ETFs that invest in, say, the United Arab Emirates, and I certainly don't know a great deal about their economy, and I wouldn't feel comfortable advising most people to go out and do that unless they really have a good idea of what's going on there.
What about ETFs that track sectors that are super narrow?
Absolutely. So this is another idea that I really don't advise. They're kind of slice of a slice ETFs, if you will. So it's one thing to say go for a healthcare ETF, but a number of years ago, HealthShares issued a number of ETFs that were dedicated to various subsectors of the healthcare economy, such as dermatology and wound care. Didn't garner a lot of attention. It actually folded fairly quickly.
Trend ETF sounds very similar.
Very similar, a lot of the same ideas here. It's really hard to identify a trend too early on. For instance, internet ETFs, they did great for a long time until that bubble popped. And if you're looking at, say, a marijuana ETF now or a Bitcoin ETF right now, you're not necessarily sure of where it's going to go in the future, and it's a little bit too soon to hitch your wagon to the latest craze.
You know what I think is interesting about this? I think ETFs are a victim of their own success. They had such success with really plain vanilla indexes, S&P 500, Wilshire 5000, that after a while they were trying to replicate that with other new ideas, but eventually it doesn't work. Right, Kaitlin?
Absolutely. There's a lot of great ETFs out there, especially those that track broad market indexes. But when you start to get into these very niche products, that's when we really become concerned.
Okay. Kaitlin, thanks for coming on the show. Appreciate it.
Thanks for having me.